So let me take this opportunity. I welcome you to our today's session. We are doing double taxation treaties, or we are calling it cross-border issues. And I remember earlier on, I was able to say these are just an agreements, or the agreements either between Kenya and foreign countries, so as to protect their citizens against being taxed twice. I said that for taxpayer to ensure a double taxation relief, there must be an existing double taxation agreement between Kenya and foreign country from where the income was earned. Secondly, the Kenyan tax on foreign income is more than the tax paid in foreign country, and the taxpayer must be a Kenyan resident. But what are some of the objectives of double taxation treaties or agreements? We say, number one, we look on the exchange of qualified technical expertise. Why does it normally happens? So there is an exchange of qualified technical expertise between two countries. Number two, that is why you could be able to see our nurses moving to UK to provide some services there. Number two, we talk about to increase the labor mobility between two countries. Number three, basically is to transfer technology from country to the other. Number four, there is a removal of trade barriers, like what you can see is happening in East African countries. We have the promotion of investments. Then number six, we have to be looking on the savings of foreign exchange. Now, the methods of implementing double taxation agreement. Number one, we normally have something called exemption methods. And this is where the income earned in foreign countries is not subject to tax in other countries. For example, the taxpayer is only taxed on income earned in the home country. So the method has a limitation of generating lower revenue to the government, and it may lead to evasion since the taxpayer is not required to disclose the income earned in the foreign country. Secondly, we discuss about the credit method, and we say under the credit method is granted on tax paid in the foreign country. That is, the tax paid in the foreign country is considered the relief, and that is the method that we are going to be using. One of the key advantages here, we are saying it generates more revenue as compared to exemption method. Secondly, it normally reduces chances of tax evasion since taxpayers are required to disclose their total income. Number three, it helps in evaluating economic cooperation between the two countries, since they exchange information about the taxpayers. But here we have some conditions that must be fulfilled. We have some conditions which must be fulfilled before granting double taxation relief. And one of those conditions, we are saying that we are saying that there must be an existing double taxation treaties between Kenya and the foreign country, another country where the income has been earned. Secondly, there must be evidence that tax has been paid in the foreign country. Number three, we say the tax paid in the foreign country should be lower than the tax paid in Kenya. Then the relief must be claimed before the expiry of 7 years. So what does this relief normally works? How does it normally works? Remember, it normally assists you to reduce your tax liability. So in that case, you are going to be it's going to be reducing the tax that you're supposed to be paying to the government. So once we consider that there is a double taxation relief, then you're going to be given a relief of a certain amount as per the computation that you are doing. The procedure of computing the double, we say determine the total income in Kenya and in the foreign country. Then we determine the total taxable liability or total tax liability of the income. Number three, we are saying that determine the tax liability of the income earned in Kenya. Then number four, we are saying determine the difference between the total liability and the tax liability of Kenyan income. That is, the actual tax payable and the foreign income. This should be compared against the actual tax paid in the foreign country. And the law of the two values in the relief should be granted. The relief should be granted. Now, that being said and done, I just want us to look on the computations. We look on how can we be able to do some few questions. The questions that you're going to be doing here, basically, they are going to be enlightening us on how we are supposed to be doing these computations as we soldier on. So we'll just be able to do 2 questions there. I will be able to do 2021 question together with the November 2016. Thereafter, we'll be able to give you an assignment. I'm anticipating that all these assignments have been, we are doing them. So let us go to the questions. Just prepare your calculator. Take your calculator and a place to write. Now, the question that we are starting with is it May 2021? It should be question 3C. May 2021, question 3C. It's always good to be reading for us. Okay. Just give me 1 minute, please. Anyone? Yes.
Ali Salama is a resident taxpayer in Kenya. During the year of income 2020, he had shillings 4,380,000 from employment in Kenya. He had also received shillings 480,000 from the United Kingdom, which has a double taxation relief treaty with Kenya. Tax deducted in UK was equivalent to shillings 80,000 required. Roman 1, double taxation relief in Kenya. Roman 2, tax payable in Kenya by Mr. Ali Salama.
Okay, thank you. The question that I can be able to see here is something that is doable. So in this case, we are just saying that this guy is being paid during the year of income. He was able to be paid 4.38 million from employment in Kenya. We have said he had also received 480,000 from United Kingdom, which has a double taxation relief with Kenya. Now we have been told that the tax deducted in UK was equivalent to 80,000. So the required is very simple. What is the double taxation relief in Kenya and the tax payable? Now, this is what we normally do. When you're doing these questions, it is very important to understand the following. We say, we compare, what we say, we normally compare what? We compare the Kenyan tax. We normally compare the Kenyan tax on total income, right? We normally compare the Kenyan tax on the total income with the Kenyan tax, with the Kenyan tax on Kenyan income. Right. Now from there also we say the difference shall be the Kenyan tax. The difference shall be the Kenyan tax. The Kenyan tax on foreign income. Right? Then also we say if the Kenyan tax on foreign income if the Kenyan tax on the foreign income is higher than the tax paid in foreign country, is higher than the tax paid in the foreign country, we say a double taxation a double taxation relief is basically granted. That is what we are saying. So these are the things that you're supposed to be doing. So when you're doing the double taxation relief, we normally follow something called we normally use the graduated scale rates. But one of the key important thing is for you to get how much did the employee got. So in this case, let us first calculate the total taxable income of the taxpayer, right? So in that regard, we have to be identifying how much you receive, how much is the Kenyan income? How much is the income you receive from Kenya? How much was the value? So in this case, from Kenya, he was able to get 43,80,000, right? Then we normally add foreign income. Now remember the foreign income was amounting to 480,000. So in this case, it means the total taxable income. The total taxable income is how much? It should be 4860. It should be 4860. 4860. Now, from there, let us come here, we take our Kenyan income. That is the Kenyan income. Then we are going to be having the total income, right? So when you look on these questions on how you're supposed to be doing them, we normally follow three things. We normally follow our graduated scale rates. Let us see it here. Is what we normally use. So what is our graduated scale rate here? Our graduated scale rate, we have it here. Can you see it? But now this a bit, I think this is not the graduated scale rate which we are using right now. Let me look for the graduated scale rate for 2023, for instance. Let us look for 2023. How much is what is the graduated scale rate now, which is applicable? That is, think is very important. So let us look on the one we used in our last exam. So this is what the students were able to use. Now, the graduate scale rate you can be able to see here, right? This is what I just want you to see. You can see the annual tax pay. This one is the one that you use. For example, we are going to be having 288, and this is the one that I'm going to be using because this is what you can be able to find in your exam in the next 1 or 2 months. So the 288,000 you normally multiply with the rates of taxes, right? Which are on percentages. So 288,000 you multiply by 10%. Then when you go to the next, you normally take 388, for instance, minus 288, you get a difference of 100,000. You multiply it with 25%. I say you take 388,000 minus 288, the difference is 100,000. You multiply it with the rate of 25%. Then the difference, we are going to be taking the difference between the total taxable income and 388,000, right? We look on that difference, then you multiply it with 30%. Let us look on how we can be able to do this. So in simple terms, when you are doing these computations, this is what we are going to be doing in an exam now. Now we are doing an exam. So in this case, I say, let me take the first 288,000. You multiply by 10%, right? 288,000 you multiply by 10%. What I'm going to be getting here is 28,800. You put on the Kenyan income and also on the total income, 28,800. Now, we look here on the next. When you say next, I said we take 388,000 minus 288,000, you get 100,000. The rate should be around 25%, right? Here we are getting something closer to 25,000 here. And also here we get 25,000. 25,000 there. Then we are going to be having the balances here. So the balances will be between what? I will be able to take the Kenyan income, which is 43,000. You subtract 388,000. Then this one you multiply by 30%. How much are you getting there? Right? So I have said we just take 4380,000 minus 388,000. Then we multiply by 0.3. Get 1167,000, 1197, 600, hapo unaweka dash, correct? Because 4380 is a Kenyan income. Can you be able to see it? Then also you calculate the balances between the total taxable income and 388,000. So how does this go? So 4860 minus 388,000. Also we multiply with 30%, right? So 4860,000 minus 388,000, right? Then we multiply by 0.3. We are getting 1341, right? 1341, 600. Get the totals here. Get your totals. So what we are getting here, it is normally called gross tax. What we are getting, it is normally called gross tax. So let me take the summation of Kenyan income. So 2,800 plus 25,000 plus 1197, 600. Here we are getting 1251. 1251, 400. The other one will be 2,800 plus 25,000. Then this time we had 1341, 600. We are getting 1395. 1395, 400, right? So this one you double. You single underline there. Then from there, let us take let us now from the total income deduct the Kenyan tax on Kenyan income, right? Less Kenyan tax on Kenyan income. So in this case, we have a tax of 1251, 400. What you are going to be getting down there, it is normally called the Kenyan tax on foreign income. Kenyan tax on foreign income. So 1395, 400 minus 1251, 400. The difference of around 144,000. Right? So in this case, when you find the Kenyan tax on the foreign income is more than the tax paid in the UK, because you're going to be comparing with the tax paid in UK. The tax paid in the UK was around 80,000 here. So let us compare between the two. When you find the tax paid in the UK, right, is less than the Kenyan tax on the foreign income, just grant the relief. So in this case, when you're making your decision here, you say there is a double taxation relief here. Then there is a double taxation relief. Why? So you come and you say Kenya shillings 80,000. Right? Kenya shillings 80,000 is a relief. Which will be granted. To Ali because the Kenyan tax on foreign income, the Kenyan tax on foreign income is more than the tax paid. than the tax paid. The tax paid in UK or in the foreign country. Just like that. Just like that. Then, from that analysis now, you can just be able to calculate your tax payable. So how am I going to be getting my tax payable? Right? We say, to get our tax payable is very simple. Let us take the Kenyan tax on total income. The Kenyan tax on total income. In our case, we have 1395, 400, 1395, 400. Then from there, okay.
Excuse me, sir.
Yes, yes.
I beg your pardon. I'm requesting if you can rewind for me that process.
Sorry?
I'm requesting if you can rewind for me that I'm not getting.
I'm not getting you clearly. You want me to rewind where? Yeah? Or from the decision that
Rewind from the decisions, and from Kenyan income and total income to getting
when you look on the Kenyan tax, there is a Kenyan tax on the Kenyan income. There is a Kenyan income which the Kenyan income you are being paid for 38,000, and that is why we have two columns here between the Kenyan tax and the total, because already we have to be determining what is the Kenyan tax on what is the Kenyan tax on the Kenyan income, and we are going to be using the graduated scale rates, right, to determine how much are you supposed to be paying. So in this case, the graduated scale rate, you normally get it in the past papers on the front page. So for example, the first one we said the 288,000. These are not the things that we are just guessing. They are these are the graduated scale rate, which is basically used now. So the 288,000 and 10%, you are getting 28,800. You apply for both, for Kenyan income and the total. Then the next one, it is 100,000. You multiply by the percentage. These ones are not even in the question, but this is the graduate scale rate. That is why it is normally provided on the cover page of the past paper, of your paper, exam paper. So you apply it for both Kenyan and the total. But when you are coming out to determine the balances, you have to be taking the Kenyan income minus 388,000. Even the 388,000 in a one reason, you can see 288 plus 100,000, 388,000. Then we multiply by what is the rate now used? So in this case, you'll be able to find these rates, the rate of taxes are being provided. In this case, we are using 30%. So these 1197,600 we are not going to be applying on the total income. Why? Because the total taxable income is 4860. So you have to be doing both. For Kenyan tax or for Kenyan income, you determine what is the tax. Then also you do for the total, you determine how much is it. But now, why are we coming here to subtract? Because they already this amount for the 380 is part of the 4860, right? To determine the Kenyan tax on the foreign income, you just need to take the gross tax of the Kenyan income, you subtract from the total, so that you can be able to determine what is the Kenyan tax on the foreign income. You'll be able to find is 144,000 by doing your computations well. Then that one you compare with the tax paid in the UK, and they say in simple terms, if you do your computations and you find the tax that we paid in the foreign country is less than what than the Kenyan tax on the foreign income, grant double taxation relief. Just provide or give a double taxation relief, and that is what we are doing here. So let us now deduct that double taxation relief. We say less double taxation relief. So how much is the double taxation relief? It is 80,000. Right? Then also you know very well, because we are using the graduated and we are doing the question for someone who is a person, is entitled for personal relief. So how much is the personal relief? We say the personal relief of ours is 28,800. So what is the tax payable? What is our tax payable? What is the tax payable in this scenario? So the tax payable, you just need to look for the difference. How much is the difference now? Determine the tax payable. I'll just be able to take that 1395,400 minus 80,000 minus 28,800. You are getting around 1256. 600. 600. That is the tax.
Excuse me, sir.
That is the tax payable.
Excuse me.
Yes, Mercy.
How did you come up with the personal relief?
I think, Mercy, you are not listening here. I have said everyone is normally granted personal relief. Even you, when you are filing your pay, unapeangwa personal relief at 2,400, and I have already explained. So when you take 2,400 times 12, this is the personal relief. And also it is in the past paper. Pale front page. Imagine this is an individual, you are doing the pay now. How much are the person kulipa? This is what is supposed to be paid.
Okay, sir.
So the 2,400 is entitled to everyone, right? Whose income is above, whose income is above how much? Actually, I had to go and 10,000 when you are computing the pay phase one. So the personal relief is always entitled to everyone. Is entitled to everyone. That one, even you are not supposed to be forgetting about it, right? Everyone is entitled. Double taxation relief means, right? This one. So once you do the comparison, unapata ile tax relief huko UK, unapata ni less than what you are able to compute, we peana tu relief. Peana tu relief. That's how easy it is. Am I breaking? Am I breaking? Hello, am I audible enough?
Yes, please.
Okay.
You are.
Thank you. Now, I just want to do the second question as we conclude on this. There is a question of November 2016, question 4B. I don't know who is unmuting. Lillian. Okay. So in these regards, now let us do another question here. There is a question tested on 2016, November. It is of a different setup. So 2016. Who's reading for us now? It's a bit different from what we are doing now. It should be question number 4B. Someone to read, please. Someone to read quickly.
Let me read.
Okay.
Mr. Silvanus Jirani was a resident of Kenya in the year of income 2015. During part of the year, he was in United Kingdom and earned income amounting to Euro 43,500. Taxes paid in UK. Taxes paid on UK income amounted to Euro 8,700. His employment income from Kenya was 950,000. Pay deducted was 184,800. Further, he had provided consultancy services at a fee of 190,000 net of withholding tax. Other income comprised the following: rental income of 400,000 after deducting cost of furniture, which is 36,000. Estate agent's fee before letting shillings 48,000 and caretaker wages of 8,000 per month. Patent rights, where he received net royalty income of 95,000. Expenses relating to patent rights were registration of patent, that is 8,900, and operating expenses of 18,000. Assume the applicable exchange rates was 1 euro to 100 Kenyan shillings is equivalent to 1 euro. Kenya has signed a double taxation agreement with the UK. Required double taxation relief if any to Mr. Silvanus Jirani for the year of 2015. 2. Refundable by Mr. Levy of income 2015.
Okay, thank you. When you look on this question, it's different a bit with the other question that we have done, but it is very good to understand the two concepts. Okay. Now, when you look on the question, I have said it is a bit different from what we have done earlier on. But when you look on this question, mostly, it requires to calculate the total Kenyan income. And to determine our total Kenyan income, what we are supposed to be doing is very important. We are going to be calculating, the first thing that we have to be doing is the computation of the Kenyan income. This is what we are supposed to do. This is what we are supposed to do here. So what is our Kenyan income? We say the Kenyan income does not have any problem, right? Let us first calculate the Kenyan income. The Kenyan income here. So we have the column of Kenyan shillings there. So how much is the Kenyan income? We are being told that Mr. Silvanus Jirani was a resident of Kenya in the year 2015. During part of the year, he was in United Kingdom and earned an income amounted to 43.5 euros. Now, that being said and done, what we are being told, the tax paid on UK income amounted to 8,700. But his employment income from Kenya was 950, right? So here we look on, what is the employment income? What is our employment income? We have been told is 950,000. Then we add, after deducting what? We have been told they were able to deduct 184,800. So how much is this, right? So I just need to take the gross amount. I just want to determine. So plus 184,800, we get 1134. 1134,800 there. Now from there, can we be able to look on any other? Because we are being told other income comprised of, we have the rental income, which we are being given there. So we talk about the rental income and we say, under the rental income, I can be able to make an assumption and I say, it is a residential Once I say it is a residential, there is a condition, right? To tax any income from a residential, it should be hitting a threshold of 15 million, right? Currently, it is not. Now, ours is very is less. Secondly, here we are being told that she has, or he has, he has a consultancy fee. So how much is our consultancy fee? We say the consultancy fee of consultancy. We have a consultancy fee, but we are being told it is a net. You have to return it to the gross. So in this case, the consultancy means they have already deducted the 5%. So the figure which we have been given, for example, for 190,000, it is it equates a proportion of 95%. So you say, what about 100? So we multiply by 100 over 95. We need to get the gross amount. So 190,000 times 100, we divide it by 95, and I'm going to be getting 200,000. We get 200,000 there for consultancy fee. Then also we are being told, right? We are being told there, we have royalties in additional number 2, where we are being told the patent rights where he received a net royalty income of 95,000, right? So in this case, I need first to take the net royalties. We look on the deductions which they made. So in this case, we have 95,000, right? Is 95,000. But we have been told expense related to the patent rights were registration of the patent amounted to 8,900, which is a disallowable. We add it back. We add the registration. So the registration we have how much? 8,900. So what is our gross royalty here? So it means I just need to take 95,000 plus 8,900. We get 103,900. 103,900 there. Then I can see we don't have any other income. We can now be able to get the total Kenyan income. The total Kenyan income is how much? So 103 plus 200,000 plus 1134, 800, getting 1438, right? Then we add, what are we adding now? We are going to be adding the income which he was able to get from the foreign country. So what is our foreign income? And we are being given the exchange rate, right? So he was able to get some value amounting to 43,500, right? To change it to Kenyan shillings is 100. So this translates to around 43,50,000. 43,50,000. Then you ask yourself, what is the total taxable income? What is the total taxable income? So plus 43,50,000. We get 57,88,700. Now, from here, we use graduated scale rate of ours. So hapo unasema Kenyan income, galia tena masi, then hapo utakuwa na total. Correct. Then we start. The graduated scale rate inaanza na 288,000. We say, first 288,000. You multiply it with 10%. Getting 28,800. Also, you put here 28,800. Then the next, we say it is a difference between 388,000 and 288,000. You get 100,000. The proportion is 15%. The 1525, sorry. So this translates to 25,000 here. Pia unaipeleka hapa kwa total. Naika 25,000. Then we have balances now. The balances that we will be able to factor in, we are discussing about, right? We are discussing some balances. We start with the total Kenyan income, which is 1438,700, right? Minus 388,000 times 30%. Correct? Plus 30%. So in this case, it will be 14 38, 700 minus 388,000. Then we multiply by 0.3, getting 315, 210, hautaweka kwa total. Then also we have the balance ingine. Unakuja unachukua now this one. 5788, 700 minus 388,000 times 30%. Right? So 5788, 700 minus 388,000, correct? Then we multiply by 0.3, getting 1620, 1620 to 10. Correct. Now let us get our gross tax. So how much is our gross tax? 1620 to 10 plus that is 53,800. Yeah? 53,800 translating to 16. You can confirm the answer, 1674,010. Then here we are going to be having 315, 210 plus 25,000 plus 28,800, getting 369,010. Then here you say, let me less Kenyan tax on Kenyan income. Right? So here we subtract 369,010. What you are going to be getting here, it is something called the Kenyan tax on foreign income. Kenyan tax on foreign income amounts to how much? So 1674,010 minus my answer, getting 1305. Then this one we compare with the, right? We compare with the tax paid in UK. The tax paid in the UK in Ngapi. We were being told he was able to pay around 8,700. We just multiplied with the 100. He paid 807,000. When you compare between the two, we said, when you look on the tax paid in the UK, equal double from what we have computed, peana to relief. So in this case, when you are calculating the tax payable here, when you are calculating your tax payable, what do you require to do? We are going to be taking the Kenyan tax, right? The Kenyan tax on total income. We got a 1674,010. We less double taxation relief. How much is the double taxation relief? 870,000. Right? We have another thing called pay. How much is the pay? 184,800. Then the other thing that we have here, we have a thing called what else? Personal relief. How much is the personal relief? We have 28,800. How much is the tax payable? 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 How much is the, so 1674,010 minus 870,000 minus 184,800, right? Minus 28,800, getting 590,410, right? 590,410. Oh, I have forgotten. Hatujamaliza hapo. Why? Let me show you why. Hapo hapana. We less here, we also less the withholding tax reliefs, We have one for royalties. 5% of the gross amount. Gross is how much? The royalties gross was 103,900. Then the other one would be the consultancy fee. 5% of, how much was the consultancy? 200,000. Sasa inakuwa ngapi? 0.05 times 103,900, getting 51.95. The other one would be 10,000. So the tax payable ni ngapi? How much is the tax payable? How much is the tax payable? So we are going to be having 1674, 010 plus 870,000 plus 184,800 plus 28,800. How much is this? Mercy, how much is the answer?
$575 to 15. 75 to 15.
575. Something I just wanted to clarify here. This one is not the gross amount. Kuna operating expenses walikuwa wametoa. Operating expenses. Na withholding tunapeananga on the gross amount. So how much was the operating expenses? Kulikuwa operating expenses walikuwa wametoa hapo za 18,000. We include them here. Ndio upate what was the gross amount? What was the gross amount? Ukichukua 103,900 plus 18,000 times 0.05, this one should be 60. It should be 6095. 6095. So ukichukua 0.05 times 103,900 nichukue 575. No, hiyo itanipea answer. 1674,010 minus 870 minus 184,800 minus 28,800 minus 6095 minus 10,000. 574,315. 574,315. Any question? Any question? So assignment on these. Gonna August 2022. Question number 3A. August 2022. Question number 3A. Question number 3A. That is the assignments. Let us see if we have something that we can be able to do now and be completed. Let me see the time first. Okay. I just want to look on the something called taxation of saccos. So let me search here. So taxation of saccos. This is very simple. So here we are saying, when you're looking on the taxation of saccos, we are saying that a sacco now, we know the saccos, they are normally formed for the benefit of its members. So the members normally contribute their money as per the specific investment which they want to achieve. Then you have to be understanding that the taxman normally they normally assume that the income which already we are depositing on the saccos, these are the income which has already been taxed. Therefore, we are saying no operating income of a sacco, right? No operating income of a sacco. Those are the income earned from members is taxable, right? Then also we have said the operating expenses are also disallowable expense. A sacco does not, we are not going to be factoring any expenses whatsoever. But when we look at it, we have been saying, or we are saying, a sacco will therefore only be taxed on income earned from third parties to the extent of, one, the 50% of the gross income from the 50% of gross, let me talk about non-qualifying investment income. These are the things that we are discussing about the interest and dividends. Now, we also have things like, these are the things, for example, dividend received from secondary cooperative societies, should be the cooperative societies, and interest received from financial institutions and government securities. Then that is where we are saying its gross income from any rights granted to the use or occupation of any property, not being royalty ascertained in accordance to the provisions of the Income Tax Act. The gain chargeable to tax under Section 3, subsection 2, any other income excluding royalties chargeable to tax. These are the things that it is very simple, for instance, to do the computations of saccos. Now you'll be able to do one question here. There is a question which was tested on November 2016. We'll be able to see on, there is a question in December 2021, question 2A. Okay, I will just be able to do all of them. So let us do the questions very quickly. So let us start with November 2016. November 2016 here. So November 2016, which paper is this? It should be November 2016 also. So the question should be somewhere here. It should be question number 3A. Someone to read, please. Please.
Okay, I'll read it. Jamboree Circle Society Limited reported the following income and expenditure for the year ended 31st December 2015. Income, we have gross rental income, interest on savings account, interest on members' loans, interest on fixed deposit account, interest on treasury bills. Then we less expenses, that's repainting of rented property, interest on loans for money invested in treasury bills, administration expenses, legal expenses relating to rented property. So on the additional information, the first one, the SACCO declared dividends and bonuses of 980,000 shillings. The second one, corporation tax is at the rate of 30%. So required, one, the total taxable profit for the SACCO for the year ended 31st December 2015, 6 marks. And then tax payable by the SACCO for the year ended 31st December, 2 marks.
Thank you so much. So when you look on the questions, the question which you are able to read, you'll be able to understand that what you are going to be factoring here should be the income from the third parties. And what is this income from the third parties, right? What is the income which we are anticipating are coming from the third party? So in this case, we are saying that we just need to identify from the income, because we said very well, the income which already we are getting from the expenses, the operating expenses, we have said they are not part and parcel, they are disallowable expenses. So in simple thing, or in simple illustrations here, we are being told, can we be able to calculate the total taxable income? And in this case, I can be able just to identify these questions. So let me see here, right? This is what you're supposed to identify your income, sorry. So in that case, I will be able to start with the title. We are talking about Jabore Sacco. This society, it should be Jabore Sacco Society Limited. Right? We are doing for the period of 2015. Taxable income computation, very simple thing. So in this case, we are going to be having the column there for Kenya shillings. And I'll be able to start with the, when I look on those incomes, I can start with the rental income. Rental income, I say, this is what? I say, let me treat it as a residential. When I make that an assumption, I put a dash there. The second one is the interest on savings account. Interests on savings account. Interest on the savings account, we said we just need 50% of it. So you take 50% of that income, that is 160,000, getting 80. Now from there, we go to interest on members' loan, disallowable, but you can be able to put it here. Interest on members' loans, like a dash, right? Then we have things like interest on fixed deposit accounts. Interest on fixed deposit account, how much is this? We have been told we take 50%, 50% of 560. This translates to 280,000, correct? Then from there, we have things like interest on treasury bills. $50% of 435,000. How much is this? 2, right? 17. I think it should be 217,500. So what is the total taxable income? Total taxable income. What is the total taxable income here? So in this case, we are going to be having 80,360 plus 217,500, getting 577. 577,500. 577,500. Then, when you want to calculate the tax liability here, tax liability, I'm going to be taking 30%. 30% of 577. How much is this? Times 0.3. 173, 250. Less withholding tax relief. Any person inakuanga already imepewa serikali. So we just need to reduce our liabilities. We start with the interest on savings accounts. Interest on savings accounts, it should be 15% of the gross amount, right? 15% of 80. So 15% of 80 is how much? Is it 20? Times 80,000. 12, sorry. We also less the interest on fixed. interest on fixed deposits, interest on fixed deposits, we take 15%. 15% of 280,000, 0.15 times 280,000, getting 42,000 here. The other one, we have the interest on treasury bills, 15%. 15% of 217,500. How much it is? 0.15 times 217,500, getting 32,625. What is the tax payable? What is the tax payable? I just take 173, 250 minus 12,000 minus 42,000 minus 32,625. We are getting 86,625. 86,625. That is how the computation is basically done, right? Is there any question?
Yes.
Yes.
I do not understand the 50%.
Continue.
Where we get, like, why are we doing, like, if it's interest on savings account, why are we doing the 50% of the amount?
Am I speaking to Mercy?
Carol.
Oh, Carol. Okay. Now, these are things which are on the, it's like asking me, Mwalimu, why are we using 30% on the corporation tax? It is like that. Ndio hii.
Okay.
Right? So it is
So.
it is a requirement. We are not supposed to be taking the full amount.
Mm.
So it is the same percentage coming your corporation tax rate. So the interest from the third parties, we are supposed to be when you are computing the taxable income of a sacco, you're not supposed to be taking the full amount. You're supposed to be taking 50% of the gross amount provided. So 50% of 160, so the 50% is,
Yes.
it is happening like it is graduated, right? It is constant.
Yes.
It's like the 15% for the interest. Can you see that? So these are the rates. So when you're dealing with the saccos and you have the income from the third parties, we take 50% of the whole of it.
Thank you.
Very good. Okay. Now let us look on December 2021. Just Mercy and Isomera, that's one.
Yes, question.
Okay, good.
Excuse me, sir.
Yes.
Excuse me. We are not done with the previous question for the November 2016.
Sijamaliza wapi?
Hatujamaliza kuandika.
Kwa mwisho.
Oh, kuandika.
Hiyo part.
Oh, sorry. So we can proceed to a value.
The following information relates to Msani Sacco Limited for the year ended 31st December 2020. Income statement for the year ended 31st December 2020. On the income section, we have interest from members' loans, interest from treasury bills, interest from government infrastructure bonds, 5 years, interest from ABA Bank, rental income, dividend from Mazao Sacco, dividends from Sopa Cooperative Limited, and then we have the gross income. On the expenditure side, you have office expenses, general expenses, credit loss, that is bad debts, repairs of rental property, And then we have the net profit. Additional information. Office expenses include salaries to sacco employees of 1,200, salary to caretaker of rental property of 200, purchase of office computers of 100. General expenses include depreciation of Kenya shillings 484,000 and non-performing loans to members of Kenya shillings 620,000, which were written off. Corporate tax rate during the year was 25% required. Adjusted taxable profit or loss for the year ended 31st December 2020. Hint, start with the reported profit. That's for the required one. Required 2, tax liability for the year ended 31st December 2020.
Thank you so much. The question given here, we have been told to start with the what? With the reported profits, right? So in this case, it means I'm supposed to be having the knowledge. You're supposed to be having the knowledge of how saccos normally treat the allowance, the expenses and incomes. So in this case, the question is going to be, or we are going just to be doing the question on a same on different aspects. I just be able to take the reported profit as required by the question. We add back disallowable expenses, we less allowable expenses which we don't have as per for sacco. Then we can be able to deduct non-taxable incomes. From there, now we can be able to base our arguments on some few elements, and then we calculate the tax thereon. So in that case, remember we are doing December 2021. Question number 3A, right? So the question relates to Sani Sacco Limited. Right, Musani Sacco Limited. So we are doing 2020 adjusted taxable income computation. Sorry?
I'm not seeing. I'm not seeing what you're writing.
Is it the case of for everyone? Can you be able to see? Can you be able to see? Brevin?
Yes, I can be able to see.
Okay, so let Lillian work with the issue of a network. So we are going to be having the columns here. Kenya shillings. We reduce our shillings to thousands. So we start with the, as required by the examiner, the reported profits. So how much is the reported profit? We say our reported profit as per the question is 19,140. 19,140. Then we are going to be adding back disallowable expenses. So how much is the disallowable expenses? We say we're going to be starting with the disallowable expense. We start with the expenses. So we have the office expenses, which we have been told very well there that we have the office expenses, but elaborated much in the additional information number 1. We have which normally comprised of the salary to SACCO employees of 1.2 million. We have salary to the caretaker of the rental property, 200. That does not even relate to the office. Then we have the purchase of the, so in this case, it means if I'm calculating for the office expense, right, I'll just be able to take 5,600. Then we subtract 200 for the caretaker, right? So this we are going to be having 5,400. Then next one, we have things like, we have the general expenses. General expenses. What is happening to the general expenses? We are being told there that the general expenses include depreciation of 484,000, right? And non-performing loans to members of 620,000. So the general expense of ours, all of that is allowable, 1,400. Then next we have things like we have the credits, the credit loss, which is we are calling them bad debts written off, right? Bad debts written off. We are talking about 60, correct? Then we have things like we're going to be deducting what here? We're going to be looking on we are going to be listing here non-taxable incomes. So what are our non-taxable incomes? Now, in this case, when you look on the income provided in the question, we have things like the interest for members' loans, right? Those ones, they are not subjected, they are not incomes, right? They are exempted. So we deduct them here because they are part of 19,140. The interest for members' loans. The interest for members' loans, we have something amounting to 16,200. Right. Also, I have interest from treasury bills. Right. Interests from treasury bills. Alikuwa angeweka ngapi? 50%. But here aliweka the full amount, right? Interest from the treasury bills. We have interest from treasury bills. We have things like 3,200. Are we supposed to be deducting? No, we are supposed to be deducting the half of it because the taxable income of this amount is 50%. So 50% off, because angetoa 50%, achane na 50%. Then it was the whole amount. He was able to add the full amount. So we are supposed to be deducting 1,600. Part of that 200, 1,600 is not subjected for taxation. Then we have the interest from governments. Interests from government. We talk about 50% of the interest from the government, 1,800, we get 900. Then we have things like the interest from Abba Bank. The interest from Abba Bank, we have how many? We are being given 1,500. So 50% of 1,500, getting 750, correct? Then we have things like dividends from, we have rental income. The rental income, we said, let us do an assumption. It is a residential. We have things like dividends from Mazao. How much is the dividend from Mazao? We are being told it is 1,000. The dividends from Mazao Sacco, we are being told it is 1,000. Right? Not all the full of it. So because these are the dividends from they are given to members. So how much is the total here? So you do your maths here well. You do your maths very well there. So that you can be able to get the taxable income. So you just need to take your calculator out. We start with the 5,400 plus 1,400 plus 60. You're getting 6,860. We are adding it back. What about the others? 16,200 plus 1,600.
Excuse me.
Yes.
Here, SOPA, we are not including it.
Yeah, Nani.
Dividends from SOPA cooperative.
Dividend from SOPA Corps.
Mm.
Dividend from SOPA Cooperative Limited. It was a taxable income. So we should not be deducting it.
Is there a way, how do you differentiate the taxable and non-taxable?
I will be able to, we shall be able to talk about, we're going to be talking about the taxation of investment income. I know it's something that I will be able to clear the air. So, that one should not be able to worry you too much. I will work on it to differentiate what is qualifying, what is exempt, what is the, this is 2450. Yonda kufunza, it should not be worrying you. Just know what we are treating now. Then when you are doing the taxation of investment income, we'll be in a position to work on let me see, the dividends. They're supposed to be not to 600. They're supposed to be deducted. Sorry. We shall be able to work on let me fix them here. From SOPA Corp. Isn't the dividends in letters in our members, right? So we say that these dividends letters in our members, they are not subjected for further taxation, right? So tunatoa hata zote 600. Unajua kuna dividends zinakuja zinapewa sacco. Dividends zinakuja, they are normally distributed to members. Those ones, they are not supposed to be included when they were computing their, when they were doing their income statements. So in this case, when I had 600 there, I'm supposed to be having 21,050. Is that the case? It should be looking like that, yes. 21,050. Thank you. Now, in that case, it means I just need to take 19,140 plus 6,860 minus 21,050. Here we are getting 4950. 4950. But what we need to put on the mind is that what we need to be able to understand is that when these things are basically coming in, the most important aspect is understanding where are the interests coming from, right? So the interests which are coming, they are coming from the third parties, but the dividends were subjected to be given to the members. That is why you can see the dividends we are giving them 100%. We are deducting them because they were supposed to be distributed to members. So when you are calculating your tax thereon or tax payable, let me use these words. The tax thereon, 30%, I don't know whether they were using 25% during that year, 4950. 30%, the corporation tax rate, we got to remember in 25. Let me just use 30% in our most cases. So 0.3 times 4950, but ukuna angalia, unajua ni ngapi. So here we are getting 1485. Then we let the withholdings. Withholding tax reliefs. Right? And we have many here. So we start with the treasury bills. We have treasury bills, 15%. There will be 15%. How much is our treasury bills? 1,600. The other one will be the interest from the governments. Right? We have the interest from governments. We have 15% times 900. The other one we have Upper Bank, 15%. 15% of 750. Right? What else do we have? We have some dividends which we are supposed to be subjecting. We have treasury. We have super cooperative. Super Corp, we have 15%. 15% of 600. Do we have anything else? We have some dividends from Mazao, which is 15% of 1,000. 15% of 1,000. So what is the tax payable or refundable? Let me start with the first one, 0.15 times 1,600, getting to 40. 15% of 900, getting 135. 15% of 750, getting 112.5. 15% of 600, getting 90. 15% of this is around 150. What is the tax payable? How much is the tax payable? 1485 minus 240 minus 135 minus 112.5 minus 90 minus 150. Unalipa 757.5. Yes. Carol, what are you saying?
I was just confirming the answer. I had gotten a different one, but I've confirmed.
Okay, so. Okay, thank you. Let us stop at that point. Let us keep on. Doing our revision. I think now we are on the right track for taxation. I'll just be able to do the same for AFM, for those who are doing AFM. Be able to push a bit this week to stabilize the syllabus. Then from there now, we will just be able to soldier on with our syllabus. So allow me to stop at that point.